Let's get to tomorrow's headlines right now. Headline number one, the recent sell-off in stocks conflicting with the sudden strength in the corporate bond market. So who is right, bonds or stocks? Legendary investor Stephen Weiss joins us now. Stephen, who is right, bonds or stocks?
Hi, Melissa. Well, I think that they're both a little bit right, but right now, my sense is that investors in bonds are not assuming that there can be any risk associated with the investment whatsoever. So with yields on the 10-year below 3%, I'm just not getting paid for the risk. So I take a look at J&J today, priced the 10-year this afternoon, 10-year bond at 3.17%. Yet I've got their equity yielding 3.6, 3.7. So what J&J is going to do, in addition to buying out their current debt, they'll likely buy back stock and benefit on the trade, picking up coupon.
So, Stephen, it's Joe. In terms of corporate bonds, is it time to move from high yield down to investment grade to kind of reduce that risk you talk about?
Well, investment grade has also had a pretty big rally, as has all yield instruments. I would suggest that you go into something like a Lorillard. Verizon's yielding 6.5%. It's a good proxy in the market. It's only 13 times earnings. You can also take a look at some master limited partnerships. Historically, over the last 10 years, they've averaged a return of 11% each year versus 2.6% for the S&P. Now, those have gotten a little frothy, but they grow yield at about 5% a year. So on top of the average yield, it's right now about 7%. You can have a nice total return. And Newstar is one company where the CEO is eating his own cooking. He just bought $20 million worth of the stock over the last week.
Stephen, it's Karen. I agree with what you're saying, but you could have made the same argument, and I would have made it then at the same time when you know, bonds were 1.5 higher, and yet we've just seen that trade continue to happen. Bond yields coming in, PEs going down.
That's a good point, and I agree with that. At some point, you hit the inflection point. So you started out the year with the spread between the 10-year and the S&P at about 180 bips, call it. Now you're down to 80 bips. At some point, you have to throw up your hands and say, you know what? I'm just going to go in, and it will turn. Everything always turns. It's just very tough to pick tops and bottoms.
All right, Stephen, got to leave it there. Thanks so much. Always nice to see you.
Thanks,
Stephen
Melissa.
Weiss, the author of The $1 Billion Mistake.
At 140, tremendous opportunity.
Good evening, Stephen Weiss at the prop desk. Do join us, if you would, with your chart of the day, which is a comparison between the 10-year yield and the S&P 500. What does it show to you?
It shows to me, Simon, that you've seen big divergence right now between equities and bond yields. Typically, they trade in lockstep. But over the last couple of months in particular, as the money's come off the sidelines, not from equities, but off the sidelines, into bonds, it's driven down yields. This week alone, we've seen the yield on the 10-year, which is really the benchmark, go from just under 2.5% to today it's over 2.7%. So I agree with what was said before. I think you've got to watch out for the reallocation. The other thing I'd point out is that a lot of investors that bought bonds didn't know there was principal risk there, and they're going to be the first ones to run for the exit.
There is another argument, of course, that it's as we hear from the likes of Gary Kaminsky, that it's a structural change, that it's a one-off change. Your bond yields may not come back up towards the S&P 500 because baby boomers are cashing out. You know, there's a lot of other noise around the argument that you make. It doesn't necessarily follow through, does it?
That's true. I heard what Gary said today. I just don't buy it. I think to some extent you'll see rates low for a longer period of time, but I think that was a trade to take off the risk and still get some return. We're going to see that reverse to a certain extent, and rates are going to back up. It has to happen. I wouldn't say it's a bubble, a classic bubble of the internet or home building, because on the other side of the trade is the government. They're not going to let the bubble burst, but you'll see a slow deflation of the bubble moving forward.
Okay, let's talk about where we could see some...
And then you could look at Freeport. It's two totally different stories.
That's absolutely right. If I could jump in for a second, Simon, it's Steve. In terms of Freeport, they're poised to have a very big buyback. They've always been very shareholder friendly. So Freeport is somewhat of a different trade. I'd also mention the rails. If you take a look at the rails on a historical valuation basis, they're at the very low end of valuation, typically between 13 times and 15.5 times. Right now, some are even trading below 13. The largest growth area they had in the third quarter, where volumes are above what they were expecting, are in the commodities and the hard commodities, followed by the softer ones, paper. But
so what
right
you're basically saying is the exports from America rather than the imports for the consumers?
Yes, the exports for America. There are not too many blue jeans being shipped on rails these days, not at least until Abercrombie sells down their inventory.
And is Union Pacific your top pick there?
Union Pacific's a good pick. I think right now you want to take a look at CSX as well. That's one of the cheaper stocks out there. Norfolk Southern. KSU is kind of a different story. You can buy them all. I mean, Buffett took BNI out of the equation, but they trade some as a homogeneous group.
But this, you bring up an interesting point, and Joe mentioned copper. Copper's an international play. You know, China had a...
Well, you've got the commodities. The commodities there are big infrastructure plays going on in the U.S. That's where a lot of the TARP money went, a lot of the stimulus money went to infrastructure. And there's talk of more of it. So you're seeing the rail traffic is more for the infrastructure internally. But I agree that China is always, it's always on the cusp of coming out with a disappointing number. And don't forget that it was,
A real quick question for you.
Sure.
I've been on the coal trade, and we heard from Peabody, the CEO from Peabody, say that he was looking for a super cycle in coal. That was a couple of weeks ago. We've seen it flatline, basically, and wiggle based on China. Do you think we could see a super cycle based on China-India demand?
Absolutely. And if you take a look at what China has been doing in the natural resource area, they're buying all the natural resources, including coal mines as far away as Australia, bad mines, in fact, just to get coal resources. So I agree with that. Coal traffic actually was down in the quarter for rails.
Right. I think the best rail, when we're looking at it right now, when you talk about the United States...
Stephen Weiss, you've got a final trade for us?
I do. I would stay with the optical names. I would stay with Finisar. But I would also take a look at the market next week. I think it's going to move higher. You're going to have Obama coming out. He says he's going to talk again. It'll be more meaningful, hopefully, than today's 10 o'clock conversation. It almost didn't happen. We have to stay focused on that tomorrow.
For a political position.
You'll win. That is
I think you have a campaign
He'll get my
manager.
vote, too. I agree with him. I don't think we should spend any more money.
There you go. Thank you, Stephen. Thank
You're
you,
welcome.
Joe.
Well, we're all agreed. What a lovely end to the week. All communing together on the politics. That's it for...
We believe. Joining us today, Stephen Weiss of Short Hills Capital. Stephen, it's always a pleasure to speak with you.
It's always a pleasure to be here.
Why should we believe that transports have further to go as opposed to break down at this point?
Transports are typically early cycle stocks, and this market may not be any different. Some could argue that past markets don't mean anything in terms of this market. There's so many different dynamics going on. But the transports have been acting very well. But if you break apart the transport index, you're really talking the rails, you're talking FedEx, and you're talking CHRW, which is a logistics company.
Hey,
They did a great job rationalizing their capacity in the last cycle. That continues. I think continue to see the rails move higher.
Hey, Stephen, it's Brian Kelly. I'm curious, we've seen the transports on poised to be broken out for the last 6 months to 9 months. What's the catalyst now? Maybe we're not getting a double dip, but we're certainly seeing a slowing economy. Why would they break out today?
Here's one point. FedEx is going to report earnings on the 17th. At the end of July, they increased their guidance. They took the numbers up, still a wide range. You've got consensus right now at about $1.20. Their range is 105 to 125. In typical FedEx fashion, what I believe they'll do is they'll come in slightly ahead of the range. Now, the catch there is, of course, that they've got to raise guidance for the stock at about 22 times earnings to have a more meaningful move higher. But if you take a look at the rail car loadings, figures came out for last week on NSC and CSX. They were actually pretty good. The only weak spot, funny enough, was coal. And I'm one of the believers in a coal supercycle, as you guys spoke about on the show earlier today.
All right, and lastly, Stephen, you would be a buyer ahead of FedEx earnings on Thursday. You're a believer in the FedEx story.
I own UPS. I like the yield a little better, but I'm a believer in FedEx, yes.
All right, going to leave it there. Stephen Weiss, thanks so much for joining us.
Thanks, Melissa.